So right now I'm pleased to introduce our second keynote speech of this conference. And we talked about the importance and strength of the partnership between the Conference of State Bank Supervisors, the Federal Reserve, and the FDIC. And the afternoon keynote speaker is the acting chairman of the FDIC, Chairman Martin Gruenberg.
Good afternoon, everybody. And I really appreciate the opportunity to speak at this 10th Community Banking Research Conference. The FDIC is very pleased to serve as a co-sponsor of this event, along with the Federal Reserve System and the Conference of State Bank Supervisors. Let me say a word of thanks also to the Federal Reserve Bank of St. Louis and their outstanding administrative and technical teams for hosting the conference. I'd also like to thank the conference organizing committee, led by Jim Fuchs of the St. Louis Fed, and with members of the Federal Reserve System, the Conference of State Bank Supervisors, and the FDIC for the outstanding agenda for the conference. And let me also express my gratitude to the presenters, discussants, and panelists for sharing your insights and making this conference particularly engaging. And I didn't want to let the opportunity pass to join with my colleague Esther George in recognizing our good friend John Ryan, who I knew for many years and who served for many years as the president and chief executive officer of the Conference of State Bank Supervisors. As you well know, John was a proponent of a strong community banking sector in the United States. The FDIC was proud to partner with John in service of a safe and sound banking system. And John's leadership was essential to getting this conference off the ground and to its continued success. This conference will serve as an ongoing tribute to John and to his vision that dialogue between community bankers, regulators, and researchers leads to better outcomes for all. This conference is an important vehicle to discuss recent academic research on community banking and the important policy issues that impact community banks. Community banks play a vital role in our financial system by providing credit and other financial services to communities around the United States, many of which are not served by larger institutions. Community banking is the prevalent model of banking in the United States, and that's especially true for FDIC supervised institutions. Of the 4,771 FDIC insured banks, as of June 30th, 2022, about 91% were community banks, according to the FDIC's research definition. The FDIC was the primary federal regulator for over 3,000 institutions as of June 30th, including the majority of community banks in the United States. So as a result, community banking has long been central to the FDIC's mission. The FDIC's recognition of the distinct issues faced by community banks is reflected in a number of ways. These include asset size distinctions and many important regulations, a community bank advisory committee that meets regularly with FDIC board members and senior staff, and the regular publication of a separate community bank section in the FDIC's quarterly banking profile. Community bank related research appears in the publication FDIC Quarterly and in FDIC working papers and staff studies. And our research division published two major studies of community banks in 2012 and 2020. And the 2012 study was the first of its kind. And if I may suggest, both of those studies make worthwhile reading. In my remarks today, I want to focus on the nature and importance of community bank lending, structural trends relating to bank branching, and evidence about community bank performance during the pandemic. But let me start by talking about the nature of community banks. Research at the FDIC and from the academic community, including a lot of people at this conference, suggests that community banks are especially well suited to meet the needs of their communities through their roles as relationship lenders, which is really central to the notion of a community bank. In meeting the financial service needs of small businesses and farms, community banks support the broader economy, and as we know, small businesses employ 47% of the U.S. private workforce and have contributed on average 65% of new net jobs since 2000. Recognizing the role that community banks play in the U.S. economy, and given the FDIC's specific role in supervising community banks, the FDIC launched a community bank research agenda in 2012. As a first step, FDIC researchers needed to come up with a clear, concrete definition of what a community bank is. Consistent with our conceptual understanding of community banks, the research definition incorporates measures of geographic footprint, funding sources, lending portfolios, and organizational structure into the more common asset size measures used in the literature. But to say it more simply, community banks are those serving a local geographic area that they know well, funded by stable core deposits, and reliant on a relationship lending business model. In simple terms, that's what we think of as a community bank. In the initial 2012 study and the follow-up 2020 study, we examined the characteristics, trends, strengths, and challenges of community banks relative to other non-community banks. Although the majority of institutions in the United States are community banks, their representation by assets in the banking industry was about 12% as of June 30th of this year, and that's a number that's declined steadily from the more than 30% of industry assets in the early 1990s. Yet, and this is really a critical point, community banks have played and continue to play an outsized role in providing financial services to specific kinds of customers that fuel the U.S. economy. Relative to the banking industry as a whole, community banks are responsible for 39%, nearly 40% of all small loans to farms and businesses, 29% of commercial real estate lending, and 63% of agricultural lending. Moreover, community bank branches are often the only available branches in a county, enabling more communities around the country to access the financial system. So if I may, let me elaborate a little on the relevance of the community bank business model. One lens through which the FDIC studies the role of community banks is survey evidence. Consistent with the view that the community bank business model is more conducive to relationship lending, the FDIC's 2018 report on its first small business lending survey found that small banks were more likely than large institutions to develop lending relationships through community involvement and personal attention. The report also highlights that banks of all sizes view community bank competitors as having advantages in customer service and loan processing times. And community banks' comparative advantages in relationship lending are affirmed by small businesses themselves. In the 2022 Small Business Credit Survey published by the Federal Reserve Banks, small businesses were most likely to be satisfied with their borrowing experiences when dealing with community banks. Research demonstrates that the differences in bank business models have real implications for firms and their local economies. There's extensive literature on this topic, so let me highlight two important dimensions on which community banks benefit local economies: lending in times of distress and equitable access to financial services. So first, community banks disproportionate extensions of credit to small businesses have important implications during downturns when small business borrowers are credit constrained. In an external 2018 cross-country study, researchers suggest that the relationship lending model is particularly adept at providing credit to small businesses precisely during downturns, while extending credit at similar levels during credit booms. As a result, relationship lending mitigates the negative effects of downturns on firm growth for the small business trying to hold on through an economic cycle. This is really of critical importance. And also of consequence, with respect to safety and soundness, the authors found that the effect of relationship lending on firm growth is driven by lending to safer firms rather than through relaxation of underwriting standards. Similarly, a 2021 study of the U.S. banking system during the Great Recession finds that geographies with more exposure to community banks were associated with smaller drops in employment and less negative effects on new establishments. Second, community banks play an important role in consumer access to credit. In an external 2010 study, mortgage originations increase and spreads decrease in low and moderate income communities in the presence of a bank, suggesting that it is not only through small businesses that local banks benefit their local economies. Moreover, the findings of the study suggest that it's primarily the presence of small community banks, rather than bank presence more generally, through which lower and moderate income communities benefit. And in another study, research demonstrates that minority depository institutions are associated with credit to minorities and minority homeownership. So let me now elaborate a bit on the importance of community banks through their physical bank branch presence and what that means for consumer access to financial services. So according to the FDIC's 2019 household survey, about 21% of households with bank accounts use tellers as their primary method of account access. And over 28% of these households visited a branch 10 or more times, and 83% spoke with a teller or other employee in person at a bank branch at least once during the year. A 2019 Federal Reserve study of branch access in rural areas reported that the issues posed by branch closures were most acute for seniors, persons without reliable transportation, and small businesses. Problems caused by branch closures noted by small business owners included having to frequently drive long distances to deposit or withdraw cash, the loss of a local lender with decision-making authority, and the loss of local foot traffic or local business closures as other communities that still have banks become more attractive destinations. As of June 30th of this year, insured banks operated over 79,000 offices, of which about 35% were operated by community banks. And directly to the points we've just been talking about, the presence of community bank offices differs sharply by geography. Community banks operated 27% of bank offices in metropolitan areas, 57% of the offices in so-called micropolitan counties, and 72% of the offices in rural counties. The vital role of community banks in many parts of the country is underscored by the fact that over 19% of all U.S. counties have only a community bank presence. It's clear that community banks play a critical role in providing access to banking services precisely in those communities that are the most challenged in terms of access. The number of banking offices, as many of you know, has been in decline since 2009. The number of offices nationwide has declined about 20% from the 2009 peak of almost 100,000, and branching services have become less available in some places as a result. There are currently 38 counties in the United States with no banking offices at all, a number that has remained pretty steady over time. And there are 184 counties with just a single banking office. That's up from 126 such counties in 2009. No doubt, many customers are using mobile and online banking services and are less reliant on branches. But given the importance of bank branches to some households and small businesses, as suggested by surveys, the potential economic effects of declines in the number of physical branches, especially in rural or underserved areas, would seem to be an important subject for research in the future. The last topic I'd like to discuss today, related to the previous discussion, is the role of community banks during the pandemic as a demonstration of their continued importance to the U.S. financial system. Initially launched in the early days of the pandemic, the Paycheck Protection Program, or PPP, offered forgivable loans to support payroll employment. By August 8th of 2020, over 5,000 lenders made more than 5 million loans, totaling more than $500 billion. At first glance, it's not obvious that community banks would take the lead on the extension of PPP loans, given the program's scale and rapid implementation. Yet research at the FDIC and externally demonstrates that community banks provided PPP loans disproportionately not only to their assets, but also their pre-pandemic small business loan portfolio. External research suggests that relationship lending banks were associated with more PPP loans, and FDIC research shows that although small firms were less likely to obtain PPP loans at the outset of the pandemic, that effect was mitigated for small firms with prior lending relationships with small banks. Moreover, another FDIC study demonstrates that smaller banks that invested in technology were able to supply PPP loans out of area, similar to large banks and to fintech competitors after adjusting for scale. And notably, technology-savvy community banks provided PPP loans to out-of-area borrowers without substituting away from in-area lending. Collectively, research suggests that during the pandemic, community banks were able to leverage both relationship banking and technology to support borrowers' access to critical government programs during a time of extraordinary stress. The research demonstrates that the role of community banks in the Paycheck Protection Program mattered. Increased PPP loans from community banks helped to dampen unemployment at the outset of the pandemic and reduce bankruptcy filings. And further, research suggests that a larger presence of community banks in low and moderate income communities may have reduced some of the racial disparities in PPP outcomes. Before I conclude, let me comment on one other issue of great consequence to community banks, and that's the consolidation that has been taking place over a long period of time now within the community banking sector, and it's really raised questions about the future role and viability of community banks in the U.S. financial system. I think the critical issue to understand in regard to community bank consolidation is that the majority of the consolidation that has taken place by community banks has been within the community bank sector, meaning it's, as a general matter, not large banks coming in and acquiring small banks, which they often do not have an interest in doing, but more frequently, it's a small community bank merging with a somewhat larger community bank. The resulting institution is larger, but still very much a community bank, utilizing a relationship lending model and often serving the same communities that the two institutions did previously, perhaps with a branch rather than a actual local bank, but nevertheless providing the services that community banks are exceptionally well suited to provide to those communities. So the bottom line here is that while consolidation has been taking place steadily over the past 3 decades among community banks, as a general matter, that's resulted in a smaller number of community banks, but on average, a larger size for the typical community banks, which may suggest that the remaining institutions may be more viable and sustainable over the long run, but are continuing to serve the communities in which they're located. So from an FDIC perspective, the process of consolidation is likely to continue, but it's a process that may ultimately result in a stronger and more sustainable community bank sector that continues to play a critical role in the U.S. financial system, a role that largely cannot be filled by the larger institutions. So in conclusion, allow me once again to thank the organizers and presenters at the Community Banking Research Conference for highlighting the often underappreciated roles that community banks play in the U.S. financial system. This conference, in my view, occupies an important niche in the field of banking research, and the FDIC is committed to continue to serve as a co-sponsor of this conference. So once again, thank you for giving me the opportunity to participate, and I wish you all a thought-provoking 2 days of discussion. Thank you all very much.